Welcome to Chapter 6. Up to this point in the semester, we have largely been focused on service businesses, companies without inventory. This week, we're going to look at how to manage inventory and something called cost of goods sold. Make this a little bigger here. Okay. So before we figure out how we're going to track our inventory, we need to figure out what exactly our inventory is. And that may seem like a really obvious concept. If we sell pens, then we look in the warehouse and we count the pens, right? And yes, but there's more. What we have in inventory isn't just what's in our warehouse. We might have goods that are being shipped to us or goods that we have shipped out. And depending on the terms of those shipping arrangements, goods on a truck may or may not be considered part of our inventory. Additionally, if we place goods on consignment with another dealer, those items still belong to us, even though they're not in our showroom or in our warehouse. So we have to make particular pay attention to making sure that we count the items that may belong in our inventory count but may not physically be present in our warehouse or on our showroom during the inventory count. So I'm gonna move myself here. All right, so goods in transit. There are two terms to be familiar with. The first is FOB shipping point. The second is FOB destination. And FOB stands for free on board. That's less of a concern. Don't worry about knowing that. It's just a bit of trivia. It's the words that come after that, shipping point and destination, that are the words that will tell you whether or not those goods that are being shipped belong to us or someone else. FOB shipping point is when the goods are included in the buyer's inventory. So if we're the buyer and we're buying something from one of our suppliers and it is FOB shipping point, those goods are considered ours. We are responsible for them if the, truck burns up on the road or something while it's being shipped to us. Those goods are, if the terms are FOB shipping point, become ours at the point that they roll out the back of the warehouse door and onto the truck of the carrier. Similarly, if we're the ones doing the selling and a customer is buying from us, FOB shipping point, then the minute we send those goods out our back door, they're not our responsibility anymore. Contrast that with FOB destination, where it's exactly the opposite. The goods are included in the seller's inventory until they reach the buyer's location. So the buyer will only include those in their inventory when they've physically arrived at that location. So if you are doing an inventory, the important question to ask is, are there goods in transit? And if the answer to that is yes, what are the shipping arrangements for that? Let's see. Goods on consignment. So as I had said previously, there are times where we may have goods that are in someone else's showroom but still belong to us. The terminology to pay particular attention to here is the consignor. So the consignor owns the goods. The consignee is the one who sells the goods. That would be a consignment store. If you've ever gone and needed or seen a really expensive dress or something that somebody's only worn once, they may put it in a consignment store and have that dress resold, and then they will get the money when the consignment dress shop resells that. So I think it's very common to see that with really high-end clothing. It's also very common to see it with things like antique cars, for example. If a collector wanted to sell an antique car, it would be, they will likely attract more buyers if that's in a location where lots of antique cars are being sold, and the car seller is able to attract lots of people that might like those similar cars, as opposed to me trying to sell my antique car all by myself. So the merchandise is included in the inventory of the consignor always. The consignee is not going to report the consigned goods as part of their inventory. There we go. Now, there are times when items are physically present in our inventory, but they're not in saleable condition anymore. And we don't want to continue to count those items if they're not going to result in an actual sale. It might be because they got damaged. Maybe we had a leak in the warehouse roof and those items didn't fare so well in that leak. Or you know, like in the case of technology, where new technology comes out pretty quickly, you know, if you have an iPhone that you're selling iPhones and you've got a few of last year's iPhones in your inventory, and next year's iPhones are, you know, coming in, those old iPhones are certainly, you know, may not be worth what you had originally paid for them at the time that they were the hottest technology on the market. So you may have to adjust inventory to account for damaged goods, obsolete goods, and things of that nature. And so we will record our inventory at what's called net realizable value. So what all gets included in our inventory? Obviously, in our example, once we've figured out what we have in terms of items that are being shipped, that might be in the hands of a consignment store, that are sitting in our warehouse, all of those things, is it enough to go out and just count the items and assume that what was paid for those items is our inventory cost? Not so fast. There are other items that may be included in our inventory cost. There may be shipping costs if we had to incur insurance while the items were in transit. If we had to store the items because we didn't have room for them at the time. I bought a car a number of years ago, and the car lot was very full at the time, and the salesman said to me, I had asked for a particular color, and he said, boy, we have one of those, and it's on one of our sort of satellite lots, and they had lots around town that they rented, and they just kind of kept the overflow cars out there. And so if I were the car dealer, the rent that is being paid on that would also be included in the cost of the car that was being sold. There may be discounts associated if we buy in bulk. If we pay quickly, there may be discounts. And so we're going to make sure that if we got inventory at a discounted price, that we reflect the inventory cost at the discounted price, not at the price that perhaps everybody else is being charged for it. It's what we really paid, plus all of these other things here. Now, inventory is one of those things that, depending on the item, might walk out the back door. And because of that, we want to make sure that not only do we want to have a list in our computer of what we have for inventory, but we want to physically know that what's out in our warehouse matches what our inventory records say. And so at least once a year, companies are going to go out and take a physical count. They might even close their doors for a day or two, or have an overnight inventory, and they will, you know, bring people in and count all night long to make sure that the inventory records are accurate and make any adjustments if they aren't. The counters that they will bring in sometimes don't even work for the company. Why would that be a thing? Why would you want strangers coming in and counting your inventory? Well, because they have no skin in the game if the inventory comes up short. If you've got people who are siphoning off your inventory, they may not be counting so accurately. They might record a different inventory amount to cover up for the fact that they've got inventory going into the trunk of their car out the back door. You have pre-numbered inventory tickets so that you've accounted for all that they're numbered, just like a check would be, so that you can account for all the inventory tickets. And then not only will the inventory tickets confirm that the items are there, but that they are in, whatever condition, as long as they're in good saleable condition. If they're not, they're damaged or whatever. And then you're going to have a second person go in and just double check and take a second count. And then a manager will go in and confirm. There are 4 methods that we're going to use to assign costs to our inventory. Specific identification, what's known as FIFO, which stands for first in, first out, LIFO, last in, first out, and then something called weighted average. So looking at 3 of these methods here, so we've got first in, first out, last in, first out, and weighted average. We can see identical transactions that have occurred, but they're going to yield different numbers because of how inventory is tracked. So with the first in, first out, we're going to presume that if we've bought inventory, it's unlikely we will just make one inventory order and then sell it all during the month. It's more likely that we might start off the month with some inventory and then we might add to that inventory. And so when we sell it, we need to know kind of which batch we sold out of. And that's where these cost flow methods come in. The company will elect one of these methods, or the specific identification that we'll get to in a minute. And then based on how the company elects to count their inventory in terms of their sales, will then determine. So for first in, first out, we're going to assume that the inventory we sold first was the stuff that was in our warehouse at the beginning of the accounting period. And in this case, we've got May 1st is the beginning of our accounting period, and we paid, our costs you can see went up every time we ordered new inventory to sell. We paid a little bit more for it. But under the first in, first out, we're going to assume that all of the $45 inventory that we bought on May 1st was what was sold first, and once that's depleted, then we move into the 65 and then 70 after that. And we assume at the end of the month that whatever is left in our warehouse is from the stuff that was ordered most recently, because we sold the stuff that was in our beginning inventory already. So what's that looks like here is if we just sold one item, we would, for $100, we would have a cost of goods sold, the cost of the item we sold, $45, and our gross profits, $55. Meanwhile, what's left in our inventory is $135. And again, we're only assuming we've sold one item. We're going to do more than that, but this really breaks it down very simplistically. Now let's move on to last in, first out, which, not surprisingly, is exactly the opposite of first in, first out. So last in, first out will now assume that the item that we purchased for our inventory on May 6th was the first item that we sold. It was the last one we bought. We're going to assume it's the first one out. And that what's in our ending inventory is the stuff that was already in our warehouse when the period started and any purchases we made right after that. So in this case, again, we've only sold one item, but now it will be the last one that we sold. And that will be $70. And that gives us a gross profit of $30 and an ending inventory of $110. Then we come to the weighted average method. And that's basically what it sounds like. We're going to take an average of our inventory. Sorry, 5 phone calls later, I'm back. All right, so the weighted average, we're going to take an average of our inventory cost. And every product that we sell during this time period is going to be, until we have new product that then changes the average, or product that we purchase at a different price, it's going to be at that average cost. So these 3 products added together were $180. Divide that by the 3, and that gives us a product cost of $60. So any of these products that were sold would be sold at $60, giving us a gross profit of $40 and an ending inventory of $120. So the way that the costs flow, we've got beginning inventory because it's unlikely we've sold everything in our warehouse at the end of last month. So we're probably going to start with something. We'll buy some stuff probably as well. And that gives us what's called merchandise or inventory available for sale. In other words, this is what we could theoretically sell during the month. Some of it will get sold, probably some of it will get left over. The inventory that will be sold from what we had available to sell goes into cost of goods sold. The ending inventory is what was left that didn't get sold. I'm going to stop here and go on to the next video to look at the perpetual method versus the, later we'll talk about the periodic method.